Good afternoon, everybody, and welcome to US Home Talk. I'm your host, Mike Overson at Luminate Bank. We talk everything real estate mortgages here in the Midwest and anywhere across the country. We are live every Wednesday at noon Central Standard Time, taking your phone calls, taking your questions, talking about current real estate market and interest rate and mortgage events coming up here. You can find us at our website, ushometalk.com. There you can find all of our past shows, and you can connect with us directly and all of our partners there directly as well. You can also find us on the Facebook, and we're also on the YouTube. So you can watch us live on the Facebook feed there, or you can catch us on YouTube as well. And again, anytime during the week, if you want to get in touch with us, you can go to our website, which is ushometalk.com. We do have a hotline, so we take your calls and your questions during our show. That hotline is scrolling at the bottom there. You can see 612-234-7585. If you want to connect with us during the show, you can call or text that phone number, or you can go on the Facebook live feed and you can type in comments or questions in the comment section there, and we'll answer them live during the show. With me today, no strangers to the show, my co-hosts, Jason Walgrave with the Walgrave Real Estate Group and RE/MAX Advantage Plus, and Marcus Walgrave with the South Dakota Home Team and Hague Realtors there. He is in the Sioux Falls area. Jason and I are up here in the Twin Cities metro area, Minnesota. Good afternoon, gentlemen.
Good afternoon.
Good afternoon.
We're going to talk about some crazy interesting stuff today, right? Mm-hmm. We're going to talk some loan stuff today, okay? So I know we're going to have millions of viewers tuning in to listen to what we got to talk about today because the loan stuff is so interesting, right? So before we get into this, actually, we kind of have a little, like a running joke going, right? So you have the four big items, right? When you buy a house, you have the real estate agent, you have the loan officer, you have the title closer, and then you have the insurance agent, right? Those are the big four players in there. Which is the most boring of the four?
Insurance.
Think insurance? You think insurance is the most boring, or do you think
it probably goes insurance and then title? Well, titles, yeah, title, and then I mean the loan guy just depends. I mean, if it's exciting new product, then that could be exciting, but real estate's definitely the most exciting. So Marcus and I, we got it made.
Yeah, for sure. And maybe not exciting, but like when a consumer or a customer is going through the home buying process there, who do they want to talk to the most and who do they want to talk to the least?
Well, they
right?
Want to talk to the realtor the most and the loan officer the least.
Hopefully their insurance agent is a one-time conversation, and hopefully we never hear from the title agent either, and because that's all good to go there.
I mean, because most people don't even know what a title company does, right?
Not really.
Right? No. Most buyers, I mean, they probably really. Why do we even need a title company? What do they even do? And they almost have one of the most important jobs, is to make sure you're getting clear title to this thing. And
I'll tell you what buyers really don't like doing. They don't like moving. So along with moving goes packing and all the stress that goes along with that. But almost equally as painful for buyers, they don't like mortgage applications and all the docs.
Oh my goodness,
that the mortgage company needs to get the loan done for them.
Yep.
But you got to do it. You got to do it unless you have.
You have to do it, Jason. But I mean, it's not like it was 10 years ago, or in your case when you started out, it was like 50 years ago. Where it was a lot harder to get all those docs in, thanks to the internet and online applications. I mean, you can get that stuff going fast. I mean, Mike, What do you think? If somebody has they kind of know where their documents are, everything is digital, and I mean, they could probably fill out an application in 30 minutes, maybe a little bit longer.
I would say the application part, just filling out the application, right? Filling in the boxes with the info. You're probably looking at about 15 minutes or so, depending on how fast you type. And then however long it takes you to upload your documents, right? So then you get this checklist of like, I need W-2s, I need tax returns, I need pay stubs, right? So if you have that, how long does it take you to import that? You know what I mean? You might have to go out and download, you might have to log into your bank account, right? And download a couple statements for us, upload those. You might have to go to your HR, right, website for your company and get your last few pay stubs and download those and throw them in there. It's really just, you can tell the organized borrowers, that have like folders already on their desktop with this stuff saved, right? They got their tax returns, they got W-2, they have all that, right? They can easily log in and get pay stubs. They can easily log in and get updated bank statements, and it's quick and it's easy. So, I mean, we just closed a loan in 9 days from start to finish for someone.
Whew.
And the guy was just on point, right, with all of his stuff. And it's like, that's how fast it can go, right? If you kind of are organized like that.
And that's organized on both ends, the buyer's end and the mortgage team's end. I mean, if you guys didn't do such an excellent job at what you do, there's no way you could close a loan in 9 days. I mean, that takes incredibly well-oiled systems and a process and a lot of experience. And so you guys really do an excellent job.
Yeah, we appreciate that. So highly borrower dependent for sure, though. Quick close. I tell everyone in real estate agents, like, hey, how fast can you close this? I usually come back with the question of, how good is your borrower going to be at getting me stuff? That's the number one question, right?
Yep.
We're going to do our job. Like, I know me and my team, we're going to do our part, right, to get everything through as quickly as possible. I know that, right? It's just how quickly can the borrower get us stuff? And if they travel for their job, that's the thing. Some people just don't have access, right? They travel for their job, and maybe they're a pilot, right? Where they're gone for 3 days straight because they fly to a city, and they fly back to a different city, then they stay overnight there, and then they're flying all the way around the country, and then they're finally back home 3 days later. Just the job type might be a slight hurdle in timing too. So, but
Marcus, before we get started, does it look like I've been out in the sun lately?
Yeah. Looks like you got some sun.
Folks, we are brothers. Marcus and I are brothers. We have the same mom and dad, but
I unfortunately got the old basal cell carcinoma in 2019, so I try to get as little as limited sun. Yep. If it was pre 2019, I think I'd be up there with you. So,
dude, I tell you what, those fishing shirts. You have one of those fishing shirts, Marcus? The ones that got the super thin material with the hoods and all that?
Oh, yeah.
Long sleeve.
Oh,
yep.
Dude.
The UPF 50 pluses,
Yep. I haven't touched sunscreen once this year.
Well, during your 4th of July party, I came in fully covered and long sleeve, and everybody's like, oh, you got to be so hot. It's like, when it's hot, everybody's hot. I don't care if you have a long sleeve on or not. If it's hot, it's hot. It's hot for everybody. However, after 3 hours, I'm still feeling pretty good, and because I don't have any sunburn.
So. Right.
Yeah. So they're thin. They're comfortable.
I was in Houston last week with Theodore, and you can definitely tell the people that are visiting Houston, and then you can tell the people that live there, because I couldn't believe how many. It was hot. It was like 107 heat index. How many people I'm assuming were locals, and we're talking full jeans, full long sleeve shirts, and they didn't look like they were really hot. I was
uncomfortable,
dying.
Yeah.
I was sweating all over the place, but I think you're right, Marcus. I think there's something about keeping that sun off your skin that can help you stay cooler, even if you got some additional clothes on. So,
well,
absolutely.
And to, like Mike was saying, those shirts, when you do start getting a little sweat going, they feel really cool, because they kind of get a little bit of it and on the fabric, and so
they're amazing.
Stay out of that sun.
I recommend them. They're killer. I haven't touched sunscreen once this year when it's super hot and sunny out, and I know I'm going to be outside for a while. I wear those shirts, and it's awesome. So,
yep.
All right, getting to the actual topic here. So let's talk about something that's even more awesomer, which is it's a word in the dictionary if you look it up. Awesomer. Okay, we're going to be talking about DSCR loans, right? So DSCR loans, what does that stand for? What is it? What do you use it for? Right? So DSCR, either one of you guys know what it stands for?
Debt service coverage ratio.
Yep. Debt service coverage ratio. Right? So basically all it's saying is that, hey, and these are for investment properties, okay? You can only use DSCR loans on an investment property you're going to buy. So basically, does the rental income coming in cover the monthly payment going out? That's all it is, right? That's the ratio. the ratio of the income coming in on a monthly basis versus the monthly payment, which is PITI, right? The principal and interest, the taxes plus the insurance, and HOA dues if you have HOA dues. But it's the monthly income coming in versus monthly income going out. If that ratio works to a certain percentage, boom, you're good to go. So here's some of the caveats of it. Do you need a job? Do you need income? No, you don't for these loans, right? The income is the rental income coming in on the property. So it's a lot like a commercial loan. If anyone listening has bought a commercial property and a commercial loan, there's two ways to qualify. You can qualify traditionally with your regular job income coming in and things like that, and then the payment that's going to be on that commercial loan. Or you can look at the income coming in on the commercial property you're buying, right? Versus the payment going out, and you can qualify that way. Well, basically this DSCR loan is for residential properties. It's really like a commercial qualifying type of loan. You're just looking at the building itself. It doesn't matter what you have for your personal income at all. And so that's a cool thing about it. It's a no debt to income ratio loan. So if you're an investor out there, let's say you got 5 properties right now, right? If you qualify traditionally, right, you got those 5 properties. Now we need mortgage statements for each one of those properties. We need the most recent tax statement, property tax statement. We need the most recent homeowner's insurance binder for that. We need the most recent lease that you have for it, right? 5 properties, 5 different sets of documents for each property. There's 25 uploads that you got to send to us, qualifying traditionally. While in the DSCR loan here, right, it's a no debt to income ratio. So anything that would contribute to the debt to income ratio, we don't need in the file. So we don't need to document anything on your current investment properties. We don't need to document income, your personal income.
What kind of what comes to mind to me is self-employed, business owners. What's the down payment requirement on these loans typically?
Yep. So that's a great question. So if the DSCR, so if the ratio of the income coming in versus the payment going out is 1.0 or greater, you need 20% down.
Okay.
If the ratio is 0.75 to 0.99, then you need 25% down.
Okay.
Okay.
So minimum of 20% down regardless?
Minimum 20%. Yep. Credit score will certainly play a factor into your interest rate that you're going to get on these. Now, this is a non-traditional qualifying type of loan, so your interest rates are naturally going to be higher. So, for example, I was working with a guy yesterday that for 1.5 points, his rate would have been 7.875 on here. If he was buying a property in Texas, so Texas is one of the states that does allow a prepayment penalty. So if we can do one of these loans with the prepayment penalty added to it, your interest rate is lower. So in Texas, he was going to be at 7.875 with 1.5 points. If he would have did that loan in Minnesota, if that property was in Minnesota, that he could still get 7.875, but now he would have had to pay 3 points in order to get that particular rate.
Wow. What's the prepayment term? Is it after 3 years or how?
Yep, 3-year prepayment penalty.
Okay.
And that penalty itself is 6 months worth of interest.
Whew.
So,
that's a good amount.
So if you're going to be buying this property, right, and if you think that you might be refinancing the initial loan that you get on the property within 3 years, or if you think you're going to be selling that property within 3 years, that prepayment penalty will kick in. Now in Minnesota, if you're buying Minnesota, the state of Minnesota doesn't allow prepayment penalties, so you don't have the option for that. So now you're just going to pay that. You're either going to pay a higher interest rate or you're going to pay more in points to get that particular loan. But if you're buying in Florida, Texas, Arizona, some of these other states that allow the prepayment penalty, then you have a more reasonable interest rate that you can get.
I would guess that 6 months of interest is pretty close to what 1.5 will cost you. I mean, would you say that's they're about the same?
Well, so if you're doing, depends on your loan size and stuff, but interest, if you're doing say you're going to do a $250,000 loan at 6%, your interest is, how much is interest is that? I can calculate that real quick. So
you're the numbers guy.
Yeah, I think of like a product like this, right? I mean, go ahead, Mike.
So they say $1,600 a month is the interest. So times 6, it's 10 grand.
Is that about what 1.5 will cost you? Is 10 grand?
Well, a point and a half on a $250,000 loan amount is $3,250.
Oh, geez. Okay.
3750. Sorry, 3750.
Well, that's a lot less. I was thinking they were going to be similar. Huh.
So what were you saying, Marcus?
Well, when you just kind of think of a loan product like this, right, and kind of you were saying, Mike, the traditional approach of getting financing and a lot more hoops to jump through. I mean, I think of a loan product like this. You come across that property, just hits the market. It's exactly what you're looking for. And you're just like, hey, I got to get this one under contract. I need to get this going quick and get it purchased. There's going to be some competition, being able to come in at it fast and saying, hey, we can close quick. I don't have to worry about jumping through all these hoops with this specific loan product. We can do a quick close. It'd be a great way to, expedite the process and get that property, within your portfolio sooner than later.
Yeah, like this particular gentleman I was working with yesterday, he does all higher end rentals. He's got 4 rental properties right now. They're all the cheapest one is probably $475. For a single family house, so $475,000 single family house, all the way up to about a $650.
Wow.
And he was asking me, he's like, so how high can you go on this? Like, is there a max like purchase price or max loan limit? There isn't. You can buy $1 million property, right, as an investment property, and as long as that debt service ratio, right, it meets the requirements, you can go up there and you can do that.
So would that be for 4 units and less, or do the number of units matter?
4 units and less, yep.
Okay.
Yeah.
Non-commercial.
Non-commercial.
That's a fantastic project. I mean product. Holy smokes.
Yeah. And so there's like 3 sources of income, right? You still have to qualify, right? The property itself has to qualify, right? Because we got to know the rental, we got to know the rental income coming in on the property. We need to know the monthly payment going out, right? So the 3 different ways you can document what the rental income is on the property itself. And number 1, if you can get a lease from a renter before you go to closing, then we can use 100% of that lease amount to qualify, right? To qualify the property. Number 2, you can do a long-term market rents analysis from an appraiser. So appraiser goes to the property and says, okay, a 12-month or longer lease on this type of property in this area yields X amount of dollars for rental income coming in. We get to use 100% of what that number is from the appraiser. The third way to do it is short-term rental income. So you can have an appraiser do a market rents analysis on what a short-term rental would look like, right? An Airbnb or VRBO, to say, I need you to go find comps that are VRBOs or Airbnbs, right? And show me what the short-term rental income is on this one. And we could use 100% of whatever that number is that the appraiser comes up with.
And you only need one of the 3 sources.
You only need one of the 3. Yep. So if you get an appraiser that goes out there and says, look, the long-term market rents analysis on this thing is $2,300 a month, but you already have a renter lined up at $2,700 a month. Well, we can use the $2,700 a month then to qualify the building or the property.
That's fantastic.
You talk about like that, those high-end products, and I think like that Airbnb verbal approach, right? That short-term rental. I mean, significantly higher rates, because I mean you're charging nightly, and so if you have a property that's within maybe a sports complex or a stadium or something like that, that may be high-end, you should be able to do a really good job renting that property out over the weekends and get quite a bit more for a rental rate.
Yeah. And that's one of those things too, is sometimes the short-term rentals are tougher to finance. They're tougher to qualify, for. This opens the door for that. And again, you can choose kind of the 3 ways that you want to qualify the building with, which is kind of cool. Now without knowing exactly what the rents are going to come back as, right? So if you make an offer on a property, right? Do you have a lease already when you're at the time of making an offer? Probably not, right? Do you have a market rents analysis from an appraiser to know the exact dollar amount that an appraiser is going to put on there for rental income coming in? No, right? So qualifying, right? You got to be like, okay, what's our best estimate of what we think the market rents is going to be coming in on this thing? That's what you run your prelim numbers on. You have to know that might change a little bit through the process.
Sure.
Right? Or, if you're thinking it's going to be a $3,000 rental income coming in a month and your payment is $2,800 going out, you're above that 1.0 ratio. But what happens if the rental income is a $2,700 a month and your payment going out is $2,800? Well, now you're underneath a 1.0, so you can still get the loan done, right? But now you got to come up with 25% down instead of 20.
Yep.
right? So you just got to know you got to be a little bit flexible there, because we're going to do the best we can to estimate what we can use up front. But there's no tax return. There is no, hey, what's your W-2 say last year? And that's what we use, right? We're kind of estimating what that property rental is going to be.
Does it only go in the one direction? Like if it's less than the 1.0 factor, more down payment? What if it's like a 1.5? Like you're just killing it with then do we only have to bring 15? Or 20 is kind of the minimum?
You still got to bring 20, but your interest rate's better.
Oh, sure.
Right?
Sure.
So that's your benefit, right? That's your advantage there. It's like, okay, well, this building clearly supports itself and then some. Like you can have vacancies on this thing for a while and still be fine, right? Over a year time period. So then the risk of that is much lower, and you'll get a lower interest rate because of it.
Yeah, that's great. Yeah, you're getting a double benefit. You got higher revenue and lower interest rates. So I mean that's the property that you want, right?
Yeah.
Mike, has this product been around forever? I mean, it seems like in the last 4 or 5, 6 years, there's been some easing in terms of like loan products and kind of opening it up to give people more opportunity to afford to be able to purchase real estate, or has this been a product that's been around for years?
On the commercial side, it's been around for ever, probably ever since even Jason started, back before electricity was even invented. It's slowly trickled over to the residential side because it's a make sense deal, right? It makes sense. You still got to have the credit scores, right? You still got to have the credit to do it. You still got to document that the building can support itself with the rental income coming in and the monthly payments going out. Right. So it's not like it's this loosey goosey, no income, no asset. We're just going to hey, if you got a decent credit score and 5% down, we're going to give you this loan. And I hope you don't default on it. You know what I mean? We're crossing our fingers. This is actually like, hey, we're documenting that the building can support itself, right? Based on this information that we get in, and you still got the credit score and you still got to have 20% down into it. Mm-hmm. So it's a make sense deal. If we go back to like regular make sense underwriting, like if you think about that, that makes sense.
It does. So, it does. I mean, it's a great option for folks. It's makes sense for the banks, like you just said. I mean, the lower risks. I mean, the numbers speak for themselves. And what better way to approve a loan than on the asset itself? It's like we know it. We can accurately predict the amount of revenue that it's going to bring in. I mean, in my mind, that seems like a much safer loan for the bank than just a traditional home loan for a consumer that could lose their job and not having more money coming in.
Right. And think about it. Bank takes a property back on one of those DSCR loans. Well, it's only on investment properties, so it's rented out already, and you already know what the market rents are coming in on it. Yep. I mean, if you have to take this thing back and sit on it for a while, at least you have revenue coming in.
Yep.
Right, before you can unload the thing from your book. So,
I like it.
It's one of those things where it's like you're going to see more and more of this. You're going to see more and more of these kind of non-traditional, make sense type of loan products come out. Being that they're non-traditional, your interest rates will be a little bit higher on there, but it's still a make sense deal. And it'll make sense.
So with that being said, Mike, I mean, you got 20% into it, maybe 25% into it. The rate's good, maybe not as good as traditional. Another property comes up down the road, you'll be able to, as long as there isn't that prepayment penalty like it is in Minnesota, you could refinance it, pull that equity out, use that equity to purchase another one, and maybe get a better rate through the refinancing process.
You could. Yep. And you can actually do cash out refinance on these DSCR loans. So if you own an investment property now, and maybe you did a hard money loan, right? So maybe you bought an investment property, hard money loan, you're sitting at 9.5% or 10.5% interest rate, and you want to come in here and be like, I got a ton of equity in this thing. You could do a cash out on a DSCR loan on that one and pull equity out, lower your interest rate, and then take that additional cash you just took out and go buy another one. And you could do a DSCR loan on the next one too if you wanted to.
Yep. And so think about this, folks. Let's say you've identified a property that needs some renovation. So there's some equity potential, right? And so you go out and you buy that property with Mike's example, hard money loan, high interest rate. You go out and you buy it. Those loans often include renovation funds. Now you got to calculate what that property will be worth once it has been renovated, and and what it will rent out for once the renovations are complete. But I mean, this is a way where you could come in and you could buy properties, renovate them, get them rented out, do this loan, get your cash back, and go do it again and do it again and do it again, rather than the traditional way of putting your 20% down, leaving it in the deal. Well, now your 20% is in the deal, and so you can get creative with a product like this and really build a portfolio of investment properties very quickly, with a limited amount of cash that you're actually leaving in each deal. So what a fantastic way to build a really incredible real estate portfolio.
Absolutely. Yep. And it's a little bit of a mind shift, right? A little bit of a mind shift, because it is different. It's not the traditional route. But it's just so much easier. So if you're an investor out there and you're self-employed, or you're tapped out, you're maxed out on traditional financing, a lot of lenders will only give you loans if you're up to 4 investment properties, and then once you hit that, they stop. There's no limit on these, right? So if you've run into hurdles because your personal income doesn't qualify you, you're self-employed and you write everything off so you don't show income on tax returns, whatever the case may be, this is a great loan to look at now, and it'll get you back in that investment property game.
Love it.
All right, gentlemen. I hope that was super exciting for you. I know it was.
This is good.
We gotta do a legal minute. That's right.
Thank you, Evan.
Thank you, Evan. I don't know.
This is Jeff O'Brien, attorney with Hush Blackwell, with a U.S. Home Talk Legal Minute. An option to purchase or option contract is often used where a potential buyer wants to purchase the right to buy a parcel of property at some time in the future. Many times the seller, called the optionor, and the buyer, called the optionee, will enter into a written contract which specifies all the terms of the purchase when and if the buyer exercises the option to purchase. The contract will also specify the manner in which the buyer needs to notify the seller of the buyer's intent to exercise the option, which can take the form of a simple one-page notice or the execution of a written purchase agreement. One important point with options to purchase: the buyer must pay some amount of money to the seller as consideration for the option, and in the event of a dispute, the courts have the power to determine whether the consideration given for the option is adequate given the value of the property subject to the option. This is Jeff O'Brien, attorney with Hush Blackwell, with a U.S. Home Talk Legal Minute.
Thanks, Jeff. Appreciate it. All right, folks, that's our show for today. Thanks for tuning in. We'll be back next week with another topic here. You have been listening to U.S. Home Talk. Thanks for listening to us throughout the week. And visiting us at ushometalk.com. On behalf of myself and Jason Walgrave and Marcus Walgrave, we'll see you next week.